But I think that gold will do in US dollar terms. In my experience, answering the rest of the question, silver moves after gold. Silver moves after gold has established momentum. Silver moves after gold has established momentum.
In this electrifying video, Rick Rule, the CEO of Rule Investment Media, explains how gold, silver, and uranium markets operate. He shares his secrets on how to skyrocket your portfolio by knowing these hidden gems. If you're into diversifying, wealth protection, or just capitalizing on silver's momentum, this is a video you can't afford to miss. Let's navigate the silver opportunity together. So let's listen to him again.
I think we're in a really interesting place. I think we're coming into a good market precisely because we're coming out of such a bad market and valuations are so low. My experience has been that you have to climb that wall of worry, and the wall of worry has been in place. This is unique because I think we're coming into a good market and there's a big crowd. I haven't seen this occur since 1990.
Interesting.
For a very, very, very long time. So the fact that you have both reasonable valuations and people really ready and willing to take advantage of it strikes me as being unusual and fairly good. Now, I need to say, my own preference is for markets that are hated. As a check writer, I like low valuations. The fact that when I look around the hall, I actually have some competition writing checks from my own personal view is not good. But from the point of view of the market, of course, it's wonderful. The retail investor has been trained for a long time to buy narrative, not arithmetic, which is why the retail investor fails as a class. I don't know if you realize this, but in the last 7 years, I've graded for free 80,000 retail portfolios. So I've learned an awful lot about the way retail investors think. And unfortunately, while there's a subset of retail investors who do well, most retail investors follow the big picture. While money is made company by company by company. I think we're coming into a period for the next 18 months where the sector itself does well. It's important to note that if you look at this whole sector, probably only 10 or 15% of the companies are viable. And if you stick with the sector rather than good companies, you will lose, ultimately. You will lose. So it's important that people know that. I think the most important new investor in the junior sector will be established mining companies. They're generating a lot of free cash. They have pretty good balance sheets. They have underinvested in exploration for 20 years. So they have no choice but to either joint venture or buy juniors. The institutional investors who are generalist got burned very badly in mining in the decade 2000 to 2010. They're not going to come back in until it's too late. Gold moves generally on fear, and there's a lot to be afraid of. I think the broad economy is in good shape, but I think the US government is doing the best job they can to debase the dollar. And I think unusually for a government, they're being successful. I think there's a lot to be concerned with about the efficacy of US dollar-based savings. And I think that gold will benefit from that. People say that gold is breaking out to new all-time highs. That's silly. In inflation-adjusted terms, gold hasn't broken out at all. Gold has broken out against almost every currency in the world except the US dollar. But I think that gold will do in US dollar terms. In my experience, answering the rest of the question, silver moves after gold. Silver moves after gold has established momentum. What I like about silver is that it's roundly hated. The sort of silver squeeze in 2021 generated a whole new generation that hates silver. And there is nothing that I like as much as a market that's hated. The silver equity market reminds me of the uranium equity market in 2022, which was stupidly cheap and had to be bought. So while I think I'm early on the silver trade, I can't help myself because I love hate. When I see the level of hate around the speculative juniors, I know I have no competition in the space. There's at least 5 years left in this market, but the easy money's been made. We could have a 20-minute conversation on the changing structure of the uranium market and how that means that the way people invest needs to change, but we don't have time for that. The take home is this: if you were invested in the uranium juniors, they're uniformly up 300%, 400%. When they moved from being hated to being tolerated to being loved, the easy money has been made. So I personally, big speculator in the space. 3 years ago, I've taken my money off the table. I have a lot of uranium stocks left, but what I have left is just my profit. The structure of the uranium market is changing, which means that there's big money ahead of us, but the easy money has been made. Three things have happened. First of all, it got too cheap. It cost about $60 a pound, fully loaded. including cost of capital, to produce a pound of uranium. 3 years ago, we were selling it for 20. So you make the stuff for 60, you sell it for 20, you lose 40. Being a miner, you try and make it up on volume. Didn't work. Price of uranium had to go up or the lights would go out. It was that simple. People's time preference is so short that they didn't care about the arithmetic equation. They cared about whether a 20-cent stock was going to go to 22 cents. They didn't give a damn about reality. They cared all about perception. Those people are my normal victims. We'll get to lithium in a minute. What happened in terms of uranium is two things in supply. One, my former employer, Sprott, bought 50 million pounds of uranium. That supply went to supply heaven. The second thing that happened is that the Japanese, the other major source of supply, decided to turn on their nuclear fleet again. So that supply came out of the equation. We went from being massively oversupplied to having the spot market short uranium. There's a pinch. The structure of the market is changing. It's going from a spot market to a term market. Investors haven't caught up with that. That has profound implications. The implications are bullish, but we don't have enough time to talk you through that. We can do that some other time. My suspicion, I'm not an economist, I'm a credit analyst. My suspicion is that we have a real risk of an economic slowdown. And an economic slowdown will not derail a commodity market, but it'll postpone it or make it less severe. Remember that you can have shortages of supply if you reduce demand and it doesn't move prices. Looking longer term, it is unescapable that there are 8 billion of us on the planet, that we're doing a wonderful job as a species taking the 3 billion people on Earth who are the poorest of the poor and increasing their material standard of living. We will absolutely, positively, without a doubt, without fail, have supply shortages in commodities. Will it occur in 2024, 2025, 2026? Probably not. Will it occur in 2028, 2029? Almost certainly. As an investor, you need to prepare yourself for that. When I look at the oil market, I look at the fact that investor perceptions are geared by politicians. Your prime minister, my president, are both dumb enough to think that peak oil demand occurs in 2030. It's going to occur in 2065. When I look at statistics, I learned that the oil and gas industry, public and private, is underinvesting $1 billion a day in sustaining capital investment. What that means is that 2 years from now, 3 years from now, their ability to produce is impaired, which paradoxically raises prices. The political actions of oil's foes, like your prime minister, are in the oil industry investors' very best interest. The best promoter in the world for the oil industry is Justin Trudeau, maybe seconded by that great energy physicist Greta Thunberg. Here's a great piece of arithmetic for your viewers. Over 40 years, our species has invested over $5 trillion direct into alternative energies. We've lowered the market share with $5 trillion from a high of 82% all the way down to 81%. I'm not saying that there isn't room for geothermal, for solar, for wind. What I'm also saying is that oil and gas will be with us for more than the rest of my life, and I'm 70.
As we conclude this insightful conversation, I trust you've gained a trove of valuable insights into the intricate world of commodities. In the dynamic landscape of investments, armed with practical strategies and a deeper understanding, you're better poised for informed decision-making. Stay tuned for more exclusive content. Please like this video, share, and subscribe. Thank you for engaging with us on this journey of enriching perspectives. Until our next chat, happy investing.